In this chapter, we'll discuss about various facilities, that is credit facilities for corporate borrowers. Banks offers various loan products. They're known as facilities. So just like individual customers, there are various loan products for companies also. Individuals will have products like housing loans, like overdraft, personal loans, and so on. Corporate companies also have a different sort of facilities. They don't need educational loans or housing loans, right? They need some separate facilities, which we'll discuss in this chapter. First of all, the loans offered to companies are broadly classified under two heads: fund-based facilities and non-fund-based facilities. Fund-based facilities are those facilities where bank physically lends money. So there's actual flow of cash from the bank to the borrower. So example of fund-based facilities could be term loans and working capital limits, which we'll see shortly. Non-fund facilities are where they're just paper-based. Bank is not actually giving cash to the borrower, right? For example, you must have heard something like bank guarantee. There might be, say, a contractor who is constructing a bridge within a city. Say the local municipal corporation has given a tender and a contractor is building a bridge. Now, as a safety measure, the municipal corporation usually asks for the contractor to submit a performance guarantee from the bank. This is just a paper given by the bank. Okay, there's no money given. Okay, this is a non-fund facility. What that paper says is that guarantee says is if the contractor fails to execute the work as per the contract terms, then bank will reimburse the municipal corporation. It will pay money as per the contract. Okay. Now that payment arises only when the contractor fails to execute the contract as per the terms. If everything goes smoothly and the work is completed, bank need not pay any money. So that is non-fund facility. So examples of non-fund facilities are letter of credits and bank guarantee, which we'll see in detail later. Okay. Within fund-based facilities, that is facilities where bank lends money, the two main categories are term loans and working capital. Term loan is a facility where the repayment period is clearly spelled out. For example, housing loan. It's a fund-based facility, it's a term loan. So bank will stipulate repayment conditions very clearly. This loan is repayable in, say, 120 EMIs, each of 10,000. So every month the borrower has to pay 10,000. For how many months? 120 months. So such loans where part of loan is repaid at periodic intervals is called term loan. Working capital facilities are something different. They are running accounts. The loan is not repaid. Right? It continues to be in operation. It is repaid only when the account is closed. See, for example, a bank sanctions a working capital limit of 10 lakhs to a company. Now the company can draw amount from that 10 lakh limit. So on the first day it can say draw 1 lakh to buy raw material. So there is a steel company. It requires raw material iron ore. So it draws 1 lakh from the account to buy iron ore. Now the limit remaining will be 9 lakhs. So it can use still the limit up to 9 lakhs. So the second day it will draw another, say, 50,000 to pay electricity bill. Not only drawing, the company will also be receiving sales, okay? Because this company is selling goods, it will receive money from its customers. So those money, the inflows will be coming into this account. So there will be this continuous debits and credits. Right? Put simply, credit means deposit into an account and debit means withdrawal from the account. Now the balance, the outstanding balance in the working capital limit will be fluctuating. It won't be constant. So the condition is it will not cross 10 lakhs because that is the sanction limit. Within the 10 lakhs, it will keep fluctuating. When there is a deposit into the account, the balance will go up. When the borrower withdraws money, the balance will come down. Okay, so those are working capital limits. Remember, these are not repaid. Okay, they go on in continuous running. It will be repaid only when the company closes the account. Now, there is a fundamental difference in purpose for which term loans and working capital limits are sanctioned. Term loans are sanctioned to buy assets, physical assets like land, building, or machinery. On the other hand, companies require working capital to meet day-to-day expenses such as raw material, paying salaries, electricity bills, repairs and maintenance, and so on. So to meet those expenses, working capital limits are sanctioned. So the examples of working capital facilities are OCC, which stands for Open Cash Trade, SOD, Secured Overdraft. Okay, you need not know further details about OCC and SOD. That's sufficient. So some banks sanction a lot of loans to projects. So some terms you have to know regarding projects. Okay. So these are also asked in interviews. One is Greenfield Project. Greenfield Project is established. It's a new production facility from scratch. That's why we use the name green. Green means starting the work on new land covered with vegetation that has never been used for production. This is a fresh project. Starting afresh is a Greenfield Project. Brownfield project means a company chooses to purchase an already built production facility. This is a brownfield investment. Already there is an existing facility, the company has bought it and modifies it as per its requirement. This is not constructing the project from scratch. So this is a brownfield project. Then a very common interview question is BOT. BOT stands for Build, Operate, Transfer. This is a framework in which a third party, for example, the public administration, delegates to private sector entity to design and build infrastructure. Infrastructure could be like roads or something like that. Okay, and the private party will operate and maintain these facilities for the certain period, say 20 years. So for 20 years, the private party will operate and maintain this facility. Usually, you see this in toll gates. If you have ever traveled on highways, there are these toll plazas, right, where they collect fees. Now that highway, that the toll, that part of the road between one toll plaza to another toll plaza is constructed by a private party. That party will build it, design it completely, and then it will operate it. It will run that, it collect the toll fees for some period as per contract, say 10 years, 20 years. So during that period, the operator will be operating, and post that period, okay, post that period, it will be transferred to the government. So at the end of the 20 years, it will be transferred to the government. Okay, so that is BOT. There is another project called BOOT, that is Build, Own, Operate, Transfer. This is different from BOT in that the private entity actually owns the works. So during this period, that concession period, the private company will own and operate the facility with the prime goal of recovering the cost of investment. It will try to achieve higher margin. Okay, this is again suitable for infrastructure projects like highway roads and mass transit systems and power generation. There is one more a very important type of project known as SPV. SPV stands for Special Purpose Vehicle. Special Purpose Vehicle are created by companies to isolate the firm from financial risk. So normally what happens is there is say an existing company, a big company, say doing a business of 1,000 crores, a very big company. Now it wants to start a project. What it will do? It will float a separate entity known as SPV. Normally the company itself can take the project and execute it within the company, but that is risky. So what it will do? It will start a separate entity called Special Purpose Vehicle, right, and transfer the assets to the SPV for management. Right. This what happens then is, should the project fail or something happens, that entity alone will be at risk. It will not affect the parent company. Right. This parent company known as the sponsoring company, by hiving off the assets or activities to the SPV, is protecting itself from the performance of that SPV. So this isolation of assets is very important. Okay. So these assets are distant from the parent company. Hence the performance of the new entity will not affect the fortunes of the sponsoring entity. So usually SPVs are used for the purpose to reduce risk to the parent company. Okay. So in this chapter, the questions that you have to learn are: what is the difference between fund-based and non-fund-based facilities? We discussed that. Give some examples of fund-based facilities: term loans and working capital limits. Examples of non-fund-based limits: letter of credits and bank guarantees. What is the difference between term loan and working capital? The fundamental difference is the term loans will be repaid, whereas working capital limits are running limits. They won't be repaid unless the account is closed. So what is the term loan we discussed? It is repayable as per the stipulations made in the sanction. In so many months, every month so much amount. For what purposes do banks sanction term loans? Banks sanction term loans only for fixed assets, creation of fixed assets like machinery or land and buildings. What is working capital we discuss? For what purposes banks sanction working capital we discuss? That is for meeting day-to-day running expenses like raw material, power bill, salaries. Why do companies need working capital? We discuss. Give some examples of working capital: OCC and SOD. Why do we call term loan as a loan and working capital as a limit? Working capital is a limit because there is a ceiling. Say 10 lakhs is the limit. There is a ceiling. Within that limit, the borrower can operate. The balance can be anywhere between 0 to 10 lakhs. He can draw the entire 10 lakhs, in which case the balance drops to 0. He can draw only 5 lakhs, then the balance will be, remaining will be 5 lakhs. Then a sale comes to that 5 lakhs, say it's sale of 1 lakh, then the balance will be 6 lakhs. So the limit will be within the 0 and 10 lakhs. So that is the limit. Term loan is not like that. It is a loan. It keeps on decreasing the outstanding. We sanction the entire amount, say 10 lakhs loan, and every month the borrower repays, say 10,000. So it drops. Initially it was 10 lakhs. At the end of the first one will be 9 lakhs 90,000. At the second month, when the borrower makes another 10,000 payment, it will be 9,80,000 and so on. It keeps on decreasing. That's why we call it a term loan, whereas a working capital will be a limit. What is the Greenfield project we discussed? What is the Brownfield project? BOT, BOT, SPV. All this we discussed. What is the advantage of SPV? It isolates the risk. Now the performance of the SPV will not affect the financial performance of that sponsoring company.